Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer of Financial Enhancement Group. So thankful you took a few minutes to join us to cover a few weeks topics on this week's Market Carver. Actually, it's the 1st of November where we're going to talk about the job market, try to take a step back and look at the bigger picture. We're going to look at the S&P 500 trend, growth versus value, a fluctuating trend over the past 12 months, and then equity flows, which have gotten real hot into equities. First, take a step back and take a look at the job market. So the first Friday of each and every month, you have the big Labor Department report that gets a lot of attention in the media, and rightfully so, right? It's one of the biggest items, particularly for individual households, how many individual jobs we're adding into the economy. The problem with that report is that there's a lot of a noise attached to it. There's a lot of good information to dig out of it, but sometimes we can overreact to the shorter term nature of a lot of that news flow. This is one of those charts that we've referred to a time or two in the market cover, particularly for the past 18 months during this COVID cycle. It's been unique to say the very least, but also in the jobs market. One of the distinctions is the difference between permanent and temporary job loss. That distinction can get lines blurred when the main report comes out on Friday. So this is just an update on where we were. The red line is this recessionary cycle. And of course, when we started off, we got off to the worst of all time in terms of record job losses and the permanent nature. And we were racing down at a much faster track than even we saw in the great financial crisis, which itself was quite horrific. However, we settled down and eventually had permanent job losses that were just about as shallow, just right there with the 2001, which was a pretty garden variety, not too harmful of an economic recession. From there, we have been recovering, and now we are recovering much faster than that recession. But we haven't gotten all the way back, and this really speaks to a lot of the problems in terms of labor shortage. We want to point to a lot of different factors, and we should. But when we take a look back, we are still just simply recovering a lot of those jobs that were lost. So some element of this has your classic recession elements where it just takes some time for adjustments to be made for that labor to come back. So as of right now, we are still trending towards that labor coming back and getting back to where we were in terms of full employment before the pandemic set in. Moving now to the S&P 500 trend. This is a chart that Andrew Thrasher, our chartered market technician, covers each and every week in our allocation meeting, just because it's that important to look at all the minutia that is behind the S&P 500 trend, not just whether it's up or down, but really drilling down into what the overall trend is. And the top blue line on this chart, that's really the key here. A few days ago, I should say, we crossed above that blue line. That blue line marks the prior high that we saw in late summer in August. And so we have moved up and beyond that. So we got a couple things working for you. Number one, stocks like fresh air. They're at new highs. So we have investors that don't have losses on the portfolio. That is a good, healthy thing. And it's happening at a good time in terms of seasonality. The beginning of November marks the best 6-month period of the season. That doesn't mean that the market always goes up during that. It just has a tendency to do better November, December, and then on through the first part of the following year. So as of right now, we still have a very healthy trend in large cap United States stocks. Flipping now to the growth versus value. This is a dynamic that got really stretched in 2020. Over this entire cycle, going back from the end of the great financial crisis, it has been an era dominated by growth stocks. These are stocks that basically maybe don't necessarily have the best value characteristics. They may be expensive. But investors don't care. They're all about having that future growth. That's dominated by technology stocks and a handful of others. But those have been those that have been favored by investors. And it got to a point where it was historically stretched in terms of the ratio of the price of growth stocks to value had gotten really out of whack. We spent the last part of last year and the first part of this year grinding some of that back and seeing the trend move back towards value. And then over the later part of the summer, growth stocks came roaring back and reached that prior high. So from here, it's going to be really interesting to see where we go, whether or not this is another turning point to go back towards value, or if we're just still making new ground, new high territory in terms of growth stock. Clearly has our attention going forward. We have slanted a little bit back more towards value stocks. One of the reasons why value tends to do better when interest rates are rising. And we're very clearly right now in an environment that is seeing interest rates move higher. So if we do continue to see that, our expectation would be that value stocks take the baton back. If they don't, that is a clear tell and a need for us to adjust portfolios at least to some degree. Moving now to equity flows, which have just turned staggering. Investors have been pouring money into equity flows, which now have cumulatively topped $1 trillion. So just a truly remarkable amount of money flooding into the market. Now, of course, this has to get our attention from a contrarian perspective. Often when we see sentiment get a little bit too high, as most of you know, that's when there at FEG we begin to at least throw up a yellow flag and some caution. So this is nothing over the short term, nothing you have to run away from. But when we see other signs of sentiment readings get too elevated, we might want to at least take a little bit of a pause. But for right now, this clearly is a strong current and one of the reasons why the S&P 500 is continuing in its positive trend. Thank you again for joining us this week. Don't forget to schedule us for a complimentary meeting. Call us at 1-800-928-4001 or simply scan the QR code. And also don't forget you have an opportunity to listen to our Consider This program wherever is most convenient for you, whether it's a podcast or on one of our traditional broadcast partners. So thank you so much and have a great weekend.